The first stock with an increase in FII holding, even when FIIs have been selling heavily in India, is Hindustan Copper. FII holding increased by 1.34% recently. As copper prices stabilize and domestic demand for EVs and electronics surges, this PSU remains a favorite for foreign funds looking for a metal or commodity play. HCL is operating in a sweet spot of high global demand and structural domestic undersupply. As India's only vertically integrated copper producer, the stock is currently a high conviction commodity supercycle play. Global copper prices on the London Metal Exchange are currently elevated due to supply constraints in Chile and Peru, which directly inflates HCL's margins as it sells based on LME-linked pricing. The reopening of the Rakha mine, which was closed for years, is providing a fresh stream of revenue in late 2025 and 2026. Its entry into rare earth mineral exploration through its subsidiary Kabil, increasing domestic demand for the Make in India defense and electronic sectors, is another boost. Now, for my take on when to buy, right now might not be the best time to buy into Hindustan Copper. In fact, I'm looking for a chance to short it. The 600 price range is the historical resistance and it would be a strong contender for a short there. That does not mean it is not a great company to keep on the watch list though. Whenever the market creates a big opportunity, which I would expect would happen sometime this year, I will be buying into this company. The next stock is Skipper Limited, which is a leader in power transmission and distribution. Skipper saw an FII stake increase from 5.42% to 6.55%. It is a key beneficiary of the global and domestic energy transition. Skipper has emerged as a major player in the global power transmission and distribution sector. The stock is currently in a high growth phase, fueled by India's massive grid expansion and a strategic pivot towards international markets. Skipper's valuation in 2026 is anchored by its highest ever order book, which stands at approximately 8,800 crores. 76% of these orders are from domestic T&D, 11% from exports and 13% from non-T&D sectors like railways and telecom. At a market cap to order book ratio of about 0.5, there is a very strong argument for undervaluation. The company also has a massive bidding pipeline of over 30,000 crores, positioning it to hit an order book target of 10,000 crores by the end of FY26. It is aggressively entering North America, Europe and Brazil, setting up marketing subsidiaries to capture markets while looking to de-risk from Chinese suppliers. While its engineering segment dominates, the polymer or pipes business is also being scaled into a 1,000 crore brand, providing a secondary growth engine. Its main weakness could come from margins though. Approximately 50% of the order book consists of fixed price contracts. A sudden spike in steel or zinc prices can squeeze these margins and send the stock tumbling. The next stock is Authum Investment, and it has transformed from a quiet investment firm into a special solutions powerhouse, famously acquiring distressed assets like Reliance Commercial Finance and Reliance Home Finance. By 2026, the integration of Reliance Commercial Finance is fully bearing fruit, providing a steady stream of interest income and debt recoveries. Authum also holds significant stake in high-growth companies. For instance, its 42% stake in Pratap Snacks makes it a major player in the FMCG space. The stock price often moves in tandem with the value of its equity portfolio. Virtually debt-free, highly experienced management in picking undervalued corporate assets, and a massive ROE are its main strengths. Its main weakness is mark-to-market volatility though. Because a large portion of its profit comes from its investment portfolio's performance, a general market crash can lead to sharp quarterly profit drops even if the core business is fine. The next is Bank of Maharashtra, which is among mid-sized banks. This PSU has been a standout. FIs have increased their stake by 2.79% due to its superior asset quality and operation efficiency compared to its peers. Bank of Maharashtra has firmly established itself as one of the most efficient and fastest growing public sector banks in India. While giants like SBI command the volume, BOM has become an efficiency darling for investors due to its superior asset quality and industry-leading growth rates. The bank's strategy is heavily tilted towards retail, agricultural and MSME lending. In early 2026, this segment accounted for nearly 60% of its loan book growth, providing higher yields and lower risk compared to large corporate loans. BOM has aggressively adopted digital lending as well. By 2026, over 80% of its retail loans are being processed digitally, significantly lowering the cost-to-income ratio. With a capital adequacy ratio consistently above 17%, the bank has enough fuel to grow its loan book by up to 22% in 26 without needing to dilute equity. A sharp downturn in the MSME sector, though, because of global headwinds or a recession, is a major risk for this bank, and that is something I would be wary of before investing. Ashapura Minechem or AML is a standout hidden monopoly play in the industrial minerals sector. The company is currently reaping the benefits of its high-margin global bauxite and betonite operations, particularly its aggressive expansion in Guinea and its dominant position in the domestic Indian market. Ashapura subsidiaries in Guinea have scaled production significantly, providing high-grade bauxite to global aluminium majors. This vertical has become the largest contributor to the company's bottom line. Ashapura also remains the world's sixth largest producer of bentonite. As the Indian steel and infrastructure sectors boom in 2026, the demand for bentonite used for iron ore pelletization and foundry has hit an all-time high. The company has also captured a significant share of the global edible oil refining market through its value-added bleaching earth products, which offer higher margins than raw minerals. The company's financials reflect a high-growth, high-leverage model that is finally delivering on its promise. There is a strong potential for re-rating if the company pays down its debt from its high 2026 cash flows. The main risk is that a significant portion of its future growth depends on Guinea, which has seen political instability in the past. Knowledge Marine and Engineering Works is next, and it is a standout performer in the niche marine engineering and asset management sector. The company has moved beyond being just a small dredging player into a high-margin, asset-heavy marine services provider for India's port infrastructure. I have spoken about this stock for more than a year, since it was still an SME. Knowledge Marine Engineering Works operates a unique model where they buy specialized marine assets like dredgers, tugboats, and pilot crafts and deploy them on long-term government contracts. By early 2026, the company has diversified significantly though. It no longer just dredges, it provides specialized piloted services and technical ship management for major ports like Visakhapatnam, Paradeep, and Deen Dayal. In late 2025, KMEW acquired two high-capacity grab hopper dredgers, allowing them to bid for deeper draft maintenance projects which carry 15 to 20% higher margins than standard maintenance dredging. As part of the Sagarmala projects, KMEW is a prime beneficiary of India's push for inland waterways. They have secured contracts for constant depth maintenance on national waterways 1 and 2. While high government dependency will always be a problem, this stock is one of the underappreciated gems to play the India growth story. Ratnavir Precision Engineering is emerging as a critical player in stainless steel value chain. It is transitioning from a niche component maker to a diversified engineering house, focusing on high-margin segments like solar mounting structures and precision washers. One of the biggest drivers in 2026 is their solar mounting structures vertical. With India's massive push for solar capacity, Ratnavir has secured several long-term supply contracts for mounting brackets and precision hardware, which offer significantly better margins than their traditional household products. The company has fully operationalized its backward integration for SS sheets and coils at its Gujarat plants. This allows them to maintain a 12 to 14% EBITDA margin even when global raw material prices are volatile. The glut in solar power is a concern for this stock as well though, so investments must be tempered with one eye on demand. HPL Power Systems is next, and it has moved from a battery company to a high-tech railway and defense systems giant. It is one of the most prominent beneficiaries of the Indian Railways safety and modernization push. The single biggest driver for HBL in 2026 is the Kavach, or the Train Collision Avoidance System. In 2026, the Indian Railways has entered the mass implementation phase of Kavach. HBL, being one of the only 3 approved vendors, is seeing its railway electronics revenue grow at a CAGR of 40%. The company is currently executing orders worth several thousand crores. Unlike previous years where orders were pending, 2026 is the year of high volume billing and delivery. HBL is a key supplier of electronic fuses for the Indian Army and specialized batteries for submarines and torpedoes. With the 2026 boom in AI and local data storage, HBL's specialized VRLA, or Valve Regulated Lead Acid, batteries for data center backup are seeing high demand as well. It is competing directly with global players like Exide. The main risk though is the high concentration risk. If railway ministry budgets slow down, HBL will be directly impacted. I must stress though, I see a market correction ahead. Now it may happen now, it may happen in 3 months, or it may happen in a year. But I believe every stock on the market will be available cheaper than now. So any investments I make are always going to be in tranches with plenty of dry powder to buy into at lower prices.